Joining us now is Mike Enriquez, the president of Sun Life Investment Management and Trust Corporation, with assets under management worth 418 billion pesos as of end March. Good to see you again, Mike. Welcome back to the program.
Good morning, Kathy.
Yeah, Mike, your thoughts first on the peso and the Asian currencies in general, because some of the currency strategists have warned that the continued strength in the Asian currencies could spark fears of what they call a reverse Asian currency crisis with potential ripple effects in the bond market. I mean, you've just heard Jerry say there that there could be some form of a decoupling, but I'm wondering from your end, what are you thinking?
Yeah, so it was really a regional move on the strengthening of the Asian currency. So it's not just isolated to the Philippines. And I think this is really more because of the reaction from the uncertainty in the trade war, especially weakening of the US dollar, more than the strengthening of the Asian currencies. So again, that is really more of that as an effect of the weakening US dollar. But having said that, I think that's why the BSP now is more confident to say that they have more policy room to cut rates and widen the interest rate differential between the Fed and the BSP policy rate. But then again, I think we can probably see after the Fed's announcement last night that they held off on further adjustments. So meaning they are now more hawkish. So that's why there's an immediate reaction to the peso. The dollar immediately appreciated because of this, as anticipated. And I think we may probably see a correction happening soon with BSP becoming more dovish, Feds becoming more hawkish. So I think we can expect currencies in Asia start to correct because of this.
So dovish, meaning the Banco Central cutting on June 19th?
Yes, the Banco Central definitely will cut. That's our view for our house view, that they will proceed with cutting. I think because inflation was really surprisingly lower than expected from April. So I think there's a lot of room for them. And it definitely helps the economy as we continue to have elevated interest rates up to now.
Talking about the economy, we're just about 5 minutes away from the first quarter GDP numbers. What are you gunning for, and how do you think that might affect your asset allocation for, say, the second quarter and the second half of this year?
Okay, our house view is about 5.9%, slightly higher than the consensus of 5.8%. And we believe that the major driver for this is really the revival of personal consumption. And I think it's being shown as well in the first quarter earnings results. We've seen some of the consumer names, especially non-discretionary consumer names, improve double-digit income growth year on year. So I think it's really consumers starting to really pick up, becoming more confident right now in spending.
And in an election year, I mean, it's often seen as a windfall for consumer companies, much more if inflation ends up slowing faster than forecast, which it did. So what positions have you made or are you making on consumption-driven assets in your portfolio?
Well, right now, we admittedly, it's still the cyclical ones. The banks continue to enjoy the largest portion of our allocation, given that I think they continue to enjoy huge net interest margins. But I think we're slowly looking at some of the consumer names, such as Wilcon, CNPF, URC. I mean, all these companies have been showing good signs of recovery from previous years' shortfall in their targets. So I think overall, if we continue to see the trend that inflation continues to be steady, even lower, then sentiment will definitely improve from the consumer side.
So is fixed income still attractive in the second half, you think?
Well, definitely, as the BSP continues to be quite dovish, although they're on the short end of the range, we expect the long end of the range to probably adjust lower as well. In fact, right now, the 10-year is still being driven by higher U.S. Treasury rates as well as more supply from government. But nevertheless, I think there's a lot of liquidity in the system looking at deploying into longer term just to be able to catch the last wind of high interest rate. So I think overall we expect probably the 10-year government bond yield to adjust lower by at least 50 basis points.
Got that. And you're 5.9% tipping for the GDP figures in just a few minutes. Thanks, Mike Enriquez of Sun Life
Sure.
Investment Management and Trust Corporation.